Number 1. The island that doesn't exist on most maps. You're looking at a corporate registry entry for a company that owns $847 million in Indonesian mining assets. The company address is a 4-story building on a street in Georgetown, Grand Cayman. You've pulled the satellite view. The building exists. 2,847 companies are registered there. You're 3 months into a corporate restructuring role at a mid-tier advisory firm in Singapore, and this is the 14th structure you've traced today. None of them make sense until you stop trying to find where the actual business happens. The business happens everywhere. The company exists in a filing cabinet on an island where the corporate registry accepts formations online and the annual fee is $950. Your senior associate, Michelle, sees you staring at the screen and says the thing that changes how you read every structure afterward. The location isn't where anything happens. The location is what doesn't happen there. Number 2, substance without presence. 6 months later, you're building the structure yourself. A Singaporean parent needs to acquire a portfolio of Vietnamese retail properties worth $340 million. The Vietnamese properties can't be owned directly because of foreign ownership restrictions. Your firm recommends a Cayman holding company between Singapore and Vietnam. You draft the incorporation documents. The Cayman entity will have 3 directors, all provided by a corporate services firm in Georgetown. They'll sign what needs signing. They'll never see the properties. The first board meeting happens on a Tuesday via a 15-minute conference call you coordinate from your desk. 2 directors from the service provider and 1 nominee from Singapore vote to approve the acquisition structure. The entire Vietnamese operation will be owned by a company whose board has never been in the same room. You file the minutes. The structure works because Cayman has no corporate income tax, no capital gains tax, no withholding tax, and tax treaties with jurisdictions that matter. The properties are real, the income is real, the company is real in the only way that matters. It exists in law. Number 3, the treaty network. By year 2, you understand that tax havens aren't about hiding money. They're about routing it. Your firm is restructuring a European manufacturing group with operations in 12 countries. The profits accumulate in Germany. The IP licensing happens through the Netherlands, and the holding company sits in Luxembourg. You map the cash flow. Germany pays IP licensing fees to the Dutch entity. The fees are deductible in Germany. The Dutch entity pays them to Luxembourg under a tax treaty that imposes no withholding tax. Luxembourg taxes corporate income at rates that become immaterial when you structure it correctly. The money moves legally. Every jurisdiction collects what it's entitled to collect under its own laws and the treaties it signed. Nothing is hidden. You're in a conference room in Frankfurt with the client's tax director when he walks you through the substance requirements. The Dutch entity needs employees, an office, documentation of decision-making authority. You arrange for 2 employees to be hired in Amsterdam. They'll manage the IP portfolio. The substance is real, just minimal. The client's effective tax rate drops from 29% to 11%. The savings are $43 million annually. Your firm bills $890,000 for 9 months of structuring work. Number 4, permanent establishment. You're a manager now. You're advising a U.S. software company expanding into Asia Pacific. They want to sell into Australia, Japan, South Korea, and Singapore without creating permanent establishments that trigger local taxation. You build a structure where the software is licensed from a Singapore entity to end customers, but the servers are in AWS facilities that could be anywhere. The salespeople are independent contractors, not employees, and the contracts are signed by the Singapore entity's directors who never set foot in the customer countries. Australia's tax authority defines permanent establishment as a fixed place of business through which the business is wholly or partly carried on. Your structure has no fixed place. The sales happen digitally. The company books $67 million in revenue from Australia and pays Singapore's 17% corporate rate instead of Australia's 30% rate. Australia collects nothing except GST on the sales. The structure is legal. The Australian Tax Office knows exactly how it works. They've published guidance trying to close these gaps, but the guidance requires treaty renegotiation. And the treaties were written when software sales meant physical products. You're in Sydney for a client meeting when a tax partner at a Big Four firm tells you the Australian government loses an estimated $5 billion annually to structures like the one you just built. He says it without judgment. He builds the same structures. Number 5, the inversion. 18 months later, you're working on your largest engagement. A U.S. pharmaceutical company with $12 billion in annual revenue wants to redomicile. The effective U.S. federal rate is 21%, but they're paying closer to 27% after state taxes. They have $4 billion in untaxed foreign earnings that would face repatriation tax if brought to the U.S. Your firm proposes an inversion. The U.S. company becomes a subsidiary of a new Irish parent company through a merger with a smaller Irish competitor. After the merger, the Irish parent owns the entire group. The group's legal headquarters moves to Dublin. The operational headquarters stays in New Jersey. The executives stay in New Jersey. The research facilities stay in New Jersey. The Irish parent company will have 4 employees in Dublin, enough to satisfy substance requirements. Ireland's corporate tax rate is 12.5%. The foreign earnings can flow to Ireland without U.S. taxation. The company projects $340 million in annual tax savings. Congress has passed laws restricting inversions, but the laws allow it if the foreign company represents at least 20% of the combined entity's value in the prior 3 years. Your team spends 11 months structuring the merger to satisfy the percentage test. The transaction closes. The company is now Irish for tax purposes. The CEO testifies before Congress 6 months later. He says the company followed all applicable laws. He's correct. Number 6, bearer shares and nominees. You're a senior manager when you first encounter a structure you can't fully trace. A client is acquiring a manufacturing facility in Southeast Asia. The current owner is a British Virgin Islands company. You request the shareholder registry. The BVI company was formed in 2009 and issued bearer shares. Bearer shares are unregistered. Whoever physically holds the share certificate owns the shares. There's no name on file anywhere. The shares changed hands 3 times between 2009 and 2018 without any public record. In 2018, BVI amended its laws to abolish bearer shares, and the company converted to registered shares now held by a Panamanian foundation. The foundation's beneficiaries are not disclosed. You can see the company exists. You can see it owns the facility. You cannot see who ultimately controls it. Your firm's compliance team requires beneficial ownership disclosure for anti-money laundering purposes. The seller provides a declaration stating the beneficial owners are 2 Panamanian nationals. You have no way to verify this. The transaction proceeds. The structure is legal under BVI law as it existed when formed. The 2018 conversion was mandatory. The foundation is legal under Panamanian law. Your firm files the required report. The facility produces automotive parts worth $23 million annually. Somewhere in the structure, someone receives the profits. Number 7, the negotiated rate. You're a director. You're in a conference room in Luxembourg with the country's tax authority and a client planning to establish a European headquarters. The client is a U.S. technology company projecting $800 million in annual European revenue. Luxembourg offers tax rulings. You submit a ruling request describing the proposed structure. A Luxembourg holding company will own the European operating subsidiaries. It will employ 47 people in Luxembourg. It will have genuine decision-making authority for European operations, and it will receive dividends and capital gains from the subsidiaries. You ask the tax authority to confirm the tax treatment in advance. The authority issues a ruling. The dividends will be tax-exempt under the participation exemption. The royalties paid to the Luxembourg entity from operating subsidiaries will be deductible in those countries and taxed at a negotiated effective rate of 0.8% in Luxembourg after applying deductions for IP amortization and cost allocations. The ruling is legally binding for 5 years. The structure is approved. The company moves forward. 3 years later, journalists obtain leaked tax rulings from Luxembourg and publish them. The story calls them sweetheart deals. The European Commission investigates and determines some rulings constituted illegal state aid. Your client's ruling is not among those challenged. The structure remains intact. The company has paid exactly what Luxembourg agreed it would pay. Number 8. The system running. You're a partner now. You're advising a private equity fund with $6 billion under management. The fund is structured as a Cayman limited partnership. The GP is a Delaware LLC owned by a Cayman holding company. The fund invests in European and Asian portfolio companies through a Luxembourg master holding company that owns intermediate holding companies in the Netherlands, Ireland, and Singapore, depending on the target jurisdiction. The structure minimizes withholding taxes on dividends, capital gains taxes on exits, and taxation of management fees and carried interest. The LPs are institutional investors, pension funds, sovereign wealth funds, university endowments. They understand the structure. Their own legal obligations require them to minimize taxes on returns that flow back to retirees, citizens, and students. You're presenting the structure to a Scandinavian pension fund representing 900,000 workers. Their CIO asked if the structure is ethical, given that it routes returns through jurisdictions that don't tax them. You explain that every jurisdiction in the structure charges the taxes it has chosen to charge under its own laws. The pension fund's obligation is to its beneficiaries. The structure is legal. The pension fund invests $400 million. Somewhere below, a young associate is reviewing incorporation documents for a Cayman entity that will hold $285 million in Indian healthcare assets. She thinks she's learning cross-border tax structuring. You know she's learning that money doesn't stay where it's made. It goes where it's treated best. And every country agreed to let it move. The market opens tomorrow. The structures continue.